The housing crash is over. In fact, you might have missed it if you were sitting on the sidelines waiting for prices to crash lower, because the only thing that crashed was the number of transactions. Here in the state of California, we're down nearly 34% on an annualized basis to 281,000 sales. At the same time, nationwide, we're down nearly 22% to an annualized rate of 4.4 million homes. So if you were waiting for that crash in house prices, you actually missed the only crash that happened, which was the crash in the number of transactions. Because during that same period of time, we saw the statewide median home price here in California jump 7.6% from February to March, which took us from just over 735,000 to just over 791,000. Now, as I mentioned in another video, that doesn't tell the whole story, because year over year, we were actually down 7%. But here's the catch. During that same period of time, interest rates nearly doubled. So even though the price of that home dropped 7%, it became way less affordable because of how much the monthly payment increased. So we've had rising rates, we've had the number of transactions decline. So what does that actually mean for the future of the California housing market? Well, it largely depends on inventory, which is down significantly from the third quarter of last year. In fact, it's about to pass under the 2022 levels. And if we keep the same pace, it's likely to pass under the 2021 levels as well, leaving us with the lowest inventory that we've ever seen on record. And because we're seeing inventory continue to be depleted, that puts the housing market in a precarious situation, which is exactly what we're going to talk about in today's video. But before we do that, I want to take a minute and ask a favor. If you find any value in the videos that I create, do me a favor and hit that thumbs up. Not only does it show me that you support the videos, it helps the YouTube algorithm push it out to more people, which I am very thankful for. And also do me a favor and subscribe to the channel to stay updated on everything real estate related. Now, just a moment ago, I mentioned how inventory in California is about to pass under the 2022 levels. But with that said, inventory nationwide is up nearly 40% year over year, currently sitting at just 419,000 homes. Now, you can see if this current trend continues on the chart that we're likely to pass under those 2022 levels sometime in the midsummer. But here's the catch. We're down nearly 53% in inventory from the 2019 levels, which is a more normal market. And at the end of the day, there's really two main things driving the California housing market. One is interest rates, which we all know plays an effect and has an impact on housing affordability. And the second thing is inventory. In fact, if we had way more inventory than we do at the moment, because interest rates have risen so much and had such a large impact on housing affordability, we would have seen prices decline much more significantly than we've seen. But here's the thing, we haven't, because buyers can't buy if sellers aren't willing to sell. And because of this lack of supply, we've actually seen a stabilization in house prices, which is why we saw that jump from February to March here in California. So in my opinion, the inventory outlook isn't likely to change substantially anytime soon. So the only real thing that can change the housing market here in the state of California is interest rates. And as you've heard me say before, interest rates tend to follow inflation. And with that said, the CPI numbers are in, and year over year inflation has dropped slightly and now fallen for 10 consecutive months, where it's currently sitting at 4.9% compared to the 9.1% that we saw back in June. So yes, we're seeing inflation declining, but most people out there are saying it's still impacting me on a daily basis, because I'm paying more for groceries, I'm paying more for gas, I'm paying more for food, I'm paying more for everything. So while we are seeing a decline in the overall inflation numbers, we're still significantly above the Fed's 2% target. Even though the CPI report showed that CPI eased in April, it still remains stubbornly high. But here's the thing, it was more or less in line with expectations. Now, one reason we're seeing inflation remain high is because of the way some of the data is reported. Some of it is lagging data, like the rent and shelter component of the CPI number. But if you take a look at this chart here, it looks as if we may have peaked in those numbers, and you're going to start to see a large decline month over month into the next few readings, as shelter reported at 8.11% compared to 8.18% year over year. During that same time, we actually saw rent drop to 8.8%. from 8.81%. Now, while both of these are large decreases, it does show that we're starting to see the numbers move down. But here's the thing, it hasn't really shown up in the CPI numbers as of yet. In fact, if you dig a little deeper, the core CPI number, which excludes shelter and food, in fact, it's something that Powell specifically mentioned last week, was 0.266% compared to 0.294%. So excluding rent and owner's equivalent rent, today's report was 0.113 versus 0.404 last month, which is a more meaningful decline. But even with that said, we have members of the Fed like Williams saying that it's going to take time before we see inflation get back to the 2% target. So even though we haven't seen that lag report in the numbers yet, I do believe the next two reports are going to impact inflation in a meaningful way. As you can see from this chart here, when the May inflation numbers report in June, it's going to be replacing a 0.9 number. And the same thing for the June number, which is going to be reported in July, we're going to be replacing a 1.2 number. So of the current 4.9% inflation number, nearly 2.1% of it is going to be replaced in the next 2 months, which is likely to show that inflation has moderated way more than the last couple of months. And with that, we're likely to see interest rates trend lower. Right after those CPI numbers were reported, traders are pricing in an 80% chance that the Fed starts rate cuts as early as September. And the primary reason they believe that is because they think the economy is going to continue to slow in a meaningful way. Now, I'll go out there and say, I'm not sure that we're going to see a Fed cut this year. I have a hard time believing that the Fed is going to hike for 10 consecutive meetings and then all of a sudden start some quantitative easing with price cuts within just a few months following that, unless we start to see a major rise in the unemployment numbers, unless we see something major happen in the economy. Now, I will go out there and say, I don't believe the economy is in a great position. I also think you're likely to see more and more businesses doing layoffs, just a slower economy overall, which is going to lead to slower growth. But I'd love to know what you think. Do you think we're headed for a recession? If so, let me know in the comments below why you think that. And if not, I'd love to know your opinion of why you think we're going to be able to avoid it. Now, earlier in the video, and you've heard me say this several times, interest rates tend to follow inflation. Just a few seconds ago, I said that we're going to be replacing nearly 2.1% of the inflation number over the next 2 months with lower numbers. So you're likely to see a significant decline in inflation. Now, what I do want to say is, even though interest rates tend to follow inflation, I don't believe that just because we see lower inflation numbers that we're automatically going to see much lower interest rates. I do think interest rates will continue to moderate over the next couple of months towards the end of the year. I think there's a very high likelihood that you have a 5 handle on interest rates here in the next couple of months. But I don't think you're going to see 4% interest rates or 4.5% interest rates anytime soon, which means that you're likely to see a housing market similar to what we've seen over the last couple of months. One more or less moving sideways. Not a lot of inventory out there to choose from. Still enough buyer demand out there to make things difficult if you're looking to buy a home. In fact, the last couple of offers I've put in have had 20, 24, 18 offers on them. So there's a lot of demand out there, even though overall demand is down. So with the slowing economy, you're likely to see a somewhat sluggish housing market in the big picture, which means you're not going to see a lot of appreciation, but at the same time, you're not likely to see a lot of depreciation during that time either. Now, at the end of the day, you should be doing what's right for you. You shouldn't be looking at me as someone online as the end all be all of information out there. You should find a bunch of resources that you trust, listen to them, and ultimately make your own decision. But I was searching the internet today, reading different things, and I came across the same information with 2 different headlines. And the reason I want to bring this up in this video is because you have to go deeper than the headline when reading some of this information, because it's easy to get misguided when you think you're reading a reputable source. So the first headline reads is that house prices fell in the third of the US housing market during the first quarter, which looks like a very grim headline. It looks like that nearly a third of the US is declining. But then you see a different headline reporting the same information, and that says that 7 in 10 metros saw home price gains in the first quarter of 2023. So both of those headlines are reporting the same information. One is looking at the glass half empty, where the other is looking at the glass half full. And I'm not here sitting with rose-colored sunglasses on saying that everything is okay, but what I am saying is make sure you're following trusted resources and doing your homework if you're deciding to buy a house. But if you want additional information about how the California housing market is flipping right now, do me a favor and check out this video here.